Okay, please go ahead, Mr. Receiver.
All right. Thank you, Mr. Kapoor. Good afternoon, everyone, to the members of the Municipal Financial Recovery Advisory Committee. Good afternoon. Today, we are joined by Councilman Morgan on behalf of the City of Chester, Director Bracy on behalf of the Governor's Office and DCED, and Ms. Diaz on behalf of Delaware County Council. In addition, we are always joined by Mr. Kapoor serving as Chief of Staff and Mr. Cody Dill serving as Executive Assistant on this engagement. Good afternoon, everyone.
Good afternoon.
All right. We'll acknowledge Mayor Kirkland hasn't joined us here yet, but we're only a minute in.
I apologize. I'm not sure if you are. Well, Mayor Kirkland won't be joining us this afternoon today. He had an unfortunate engagement that he had to attend, so he won't be joining us today.
Okay, thank you for that, Mr. Morgan. All right, so let's jump right into the agenda then, calling this meeting to order. Our first agenda item is public comment. And surprisingly, we have not received any public comments since our last meeting. I'm sure that's an anomaly that will not continue, but there were no public comments included with your agenda packets last week because we have not received any. So moving on to our next agenda item, we have the status of the receiver's recovery plan and also the receiver's update. For today, we're going to combine somewhat those two and the third, the update on the city financial situation, and defer to Mr. Kapoor to make a presentation. Mr. Kapoor, are you ready to move forward?
I am, Mr. Receiver. Can you see that all right?
Yes.
All right, great. So good afternoon to the members of the committee and to the public. My name is Vijay Kapoor, serving as Chief of Staff to the Receiver for the City of Chester. As we discussed at the last MFRAC committee meeting, we're going to be using May here to these next two meetings to do really two things. One is today we're going to be taking a high-level update on really the key city financial issues. Obviously, there's a lot going on with the city. There has been over the last couple of years. But what we want to do today is to kind of look at the key critical issues, key critical financial issues that are facing the city and give the public and the committee an update on where we are. We'll be using the next committee meeting, which is on May 24th, to talk about possible solutions and possible options that we have to address the problems that we are going to be laying out in today's presentation. So, we want folks to really kind of think about these two meetings, really to kind of take a step back, if you will, and look at the overall situation for the city of Chester. So in particular, what we're going to be talking about today is the pension and retiree healthcare situation, as well as the water system monetization issue, because those, as we've talked about in the past, really go hand in hand. And as I said, in the next committee meeting on the 24th, we're going to be talking about solutions, talking about next steps, talking about different options on how we can address these key critical issues. So to take a slight step back, and just to remind those of you who are maybe tuning in for the first time or need a refresher, the city has three pension plans. We have one for the police, one for the fire, and one for essentially everybody else, the officers and employees, also referred to O&E. Those include the non-union, non-uniform elected officials, as well as the Teamsters bargaining unit is in the O&E plan. We've been spending obviously a lot of time talking about the police pension plan, and those of you who've been sort of paying attention or have tuned into a lot of these committee meetings. A lot of these slides will look somewhat familiar, but what we have in there is updated data, updated information on the city's situation to present to the committee as well as to the public. One of the key areas here that we really need to understand and really need to kind of drill down into and remind people about the city's pension situation is regarding the annual payments that the city needs to make into the pension funds. Those are referred to as minimum municipal obligations, or MMOs. So you'll hear us say MMO quite a bit. Think about the MMO as the annual pension payment that the city needs to make into its various plans. That number is calculated by an actuary, a specific professional who looks at the pension plans and based on assumptions and based on calculations, comes up with the number that needs to go in on an annual basis. And so, one of the things to understand here is that historically, the city has not made its full annual pension payment. In 2021, it was the first time that the city made its full MMO payment since 2014. And excuse me, really since 2013. And what you'll see on this chart is the city contributions relative to what the MMOs were. So the blue bars were what the MMO calculation was supposed to be put in, and the green bars were what was actually put in. So what we need to be able to understand is this is money, the shortfall between what was in the contribution made and the MMO is money that is owed to the pension funds. And for the purposes of the term that the actuary uses, those amounts are referred to as receivables. And so what the city needs to do is it's got to make up those shortfalls. And what also is done over here is they accrue interest penalties as well. And so the total amount that is owed to these pension funds, and mostly to the police pension fund, but really to every pension fund, is about $36.6 million as of the most recent valuation. So in terms of kind of understanding the city's financial situation, we really have to start with this number here. This $36.6 million is money that is owed to the pension funds. And the way the actuary calculates the MMO, they actually assume that this money is already in the plan. And so obviously it's not $36.6 million, but the actuary assumes, because it's considered a receivable, that it's in the plan when they go and they do their calculation. And so in order for the city basically just to put the minimum in, it needs to put in not only this $36.6 million, but as it also needs to put in its annual pension contribution, its MMO. So in the next couple of slides, we'll give you updated numbers in terms of what that overall amount is and how much it is relative to the city's general fund budget. And so if we start with the premise that, look, we've got to put in $36.6 million. And in fact, like based on if you look at kind of the way the actuary calculates the MMO, it already assumes it's in there. Outside of a monetization, the city doesn't have the financial ability to make this contribution. And what we'll see in a moment too is even if it made that $36.6 million contribution, it still results in an unaffordable annual MMO amount based on the city's current budget. So just if we look and try and put that $36.6 million in context, because obviously we can talk about the number, but it's kind of helps sometimes to put things in relative context. That's about 63.1% of the city's entire general fund budget for 2022. And what we don't include here, we don't include the $5 million emergency loan from DCED. That would be $5 million going in and $5 million going out. It would make the budget look a little bit higher, but in reality, that's really just more of a transfer for the purposes of this calculation. But if you really think about it here, that the city to pay the receivables, the $36.6 million, the city would actually need to divert about 2 out of every 3 general fund dollars it plans to collect in 2022 just to pay for the receivables, right? And the general fund is the fund that we use to pay police, fire, public works, all the general operations that we see in the city. And this is a huge amount here, right? And this is just to pay back what hasn't gone into the funds since 2014. So a significant number. Now, in 2022, we budgeted the MMO for 2022 was $10.6 million. That is the amount that the actuary calculated that said we needed to pay towards the pension funds in 2022, that annual MMO payment. Now, again, recall that that assumes this $36.6 million is in the pension plan. But so if we put it together, right, and we added the receivables, the $36.6 million, as well as the $10.6 million for the 2022 MMO payment, that total is $47.2 million, right? That's how much we would need to put in here this year, just as the minimum payment for pensions. And if we compare that to the general fund, that makes up about 81.4% of the city's entire general fund budget. So essentially, you know, this is a huge amount. And again, if we were to just quote unquote pay for it out of the city operations, we wouldn't be able to do anything else really in the city. We will only be left with about what do we have here? About around $10.8 million to spend on everything else, which obviously is just, that's not something that's sustainable. That's not something that's realistic here. Now, in terms of our funded levels, we do have some updated numbers here as of the March 31st quarterly report that we get from PNC, where the money is invested. Again, looking at the market value of assets, what we've done over here, and again, you probably recognize this slide a little bit. The update here is we've updated it with the assets as of March 31st of 2022. So based on that, and based on the pension liabilities as of January 1st, 2021, which is the most recent valuation we have, you know, we've made some improvement in the police pension plan assets. I think we were around 1.5 million as of January 1st of 2021. So we're up to around $4.7 million in the police pension plan. But overall, I mean, this is still just incredibly troubling. Our overall assets are still completely inadequate to pay for the current level of benefits provided. So the police pension fund, you know, we're around 4.8%, again, funded. And here, again, I want to call out to both the committee as well as the public. You know, this is really kind of, I would say, overstated, if you will, because this is being compared against pension liabilities as of January 1st of 2021. Those liabilities have obviously increased since that time. So these numbers here in the liabilities end are lower than what they probably realistically are. We just don't have, valuations are done every 2 years, so we just don't have an updated number here. And again, we're really, well, again, while we've seen some improvement over here, still completely inadequate to pay for the current level of benefits provided. The next chart that I want to show that we've updated and that is of key critical importance, particularly to understanding the annual budget that we have in the city, is the MMO growth. And again, the MMO is the annual pension contribution the city needs to make into its pension funds. This combined MMO, and combined meaning being in the police plan, the fire plan, and the O&E plan, more than tripled from 2013 through 2022. And so the other point I'll make over here is that as we know, these MMOs should have actually even been higher than what we've reflected in here, because they assumed those receivables were already plan assets when in reality they weren't. So we've got our 2023 MMO estimate from the actuary, and that estimate is approximately $12.5 million. That's what the actuary estimates that we need to put in we'll need to put in for 2023. That number is about $2 million higher than what we saw in 2022. It's about a 19% increase. And again, that number assumes that we've already deposited the $36.6 million of receivables, which obviously we have not. So the question that we want to ask ourselves is, like, you know, are we going to be able to afford that? And the situation we're in right now, just to understand our budget and to understand our current financial situation, is to take a look at this year's budget, and to take a look at, you know, how we've been able to balance it this year, and whether we'd actually be able to absorb this $2 million increase that we're going to be seeing just in the MMO contribution for next year. So for this year, just in order for us to balance the budget, we are relying on about $2.9 million in one-time funds from the American Rescue Plan Act, the ARPA, and that's in revenue replacement as well as return to work numbers that we've budgeted in here. And so what that means is, without that money, without the ARPA money, we don't have a balanced budget. We're not able to balance the budget, and that means that our budget is not structurally balanced. And while we're able to rely on these dollars this year, ARPA is not going to be around here forever. And ARPA funds under the law, they can be used to cover qualifying costs that are obligated, meaning kind of that's sort of a budgetary term, obligated between March 3rd of 2021 and December 31st of 2024, and expended by December 31st of 2026. So there's a lot in there, but the point is, they would need to be obligated by December 31st of 2024. And what that means is, like, we can't rely on these funds forever. They're also one-time funds. So once we spend them, they go away. And so what we saw in the previous slide was the city's annual pension contribution obligation, its MMO, is going to increase by about $2 million next year. And because our revenue growth is not going to cover this increase, just kind of organic revenue growth, whether it's from property taxes or earned income tax, isn't going to cover this increase. What that means is the structural imbalance already grows, only grows. So again, we're relying on $2.9 million this year. It's a structural imbalance. Next year, expenses always, increase, generally always increase at a rate higher than revenues. And, we've got to find at least $2 million more in order to pay for the MMOs. That's around $4.9 million that we're kind of already in the hole in for 2023. And again, that amount, that 12.5 million, assumes that this $36.6 million in receivables has already been contributed. And what's not shown here are obviously the millions of dollars that we need for capital projects that the city needs to improve its roads, its buildings, and its other infrastructure, across the city. So one of the things that we asked an actuary to do is the question.
DJ,
yes.
Excuse me, Mr. Kapoor, if I may, before we jump into this next point, there was a question asked online, and if I could piggyback Ms. Mosley's question. The original question was the correct way to calculate the actual pension payments on base salaries versus overtime pay ever rectified? Could you speak to the 2017 labor contracts, and do they fully address this issue of overtime pay being included in the calculation? And then to the point you were just making about how this problem, a structural deficit, compounds into the future, how far out is that potential relief? If 2017 addressed it, how soon could we expect that compounding to that relief to catch up to the compounding?
Right. So that's a good question, and let me answer this in a couple of different ways, and hopefully I'll kind of, it's not as clear of an answer as I think the question may be. So to start with this, going forward right now, the city is calculating, and the pension board is calculating new police retirees using the average of the last 3 years instead of the last 12 months. I believe that's kind of where the questioner is going with that. And the actuary, in the calculations they've made for the MMO, this $12.5 million, as well as a number I'm about to show you that our actuary calculated in terms of the overall numbers, is assuming that the benefit is the last 3 years rather than the last 12 months. So from our perspective, in terms of kind of the going forward, we believe that let me just say, rather than saying we believe, this is how it's being calculated. If for some reason that changes. And, we're told either by a court or by an arbitrator that no, what you really need to be doing is the last 12 months. These numbers are only going to go up. The $12.5 million will go up because the benefit essentially would be enhanced. In terms of kind of understanding, okay, how long will it take, now that we're sort of going backwards, right? And saying we're looking at previous calculations and having those calculations redone. The next time that we would see it really appear in the calculation would really be in really would be in about 2 years in terms of when the actuary would calculate it. Because what they'll do at that time is they'll look at the plan assets, right, in terms of what's actually in there, and they'll realize, okay, that's what our liabilities are right now. This is how much is actually going out of the plan. That's when it would translate to the MMO. In terms of like cash flow, though, any changes that are made right now to anyone's pensions automatically flow into the cash flow, meaning that if someone was receiving $100,000 a year and now they receive $80,000 a year, when that change is made, that's already hitting the cash flow of the pension plan, meaning the pension plan is not paying that $20,000 difference. So, that's sort of a long way, and I apologize for kind of being a little bit confusing on this. Number one, any changes to pensions that are being made right now are immediately impacting the cash flow. That's happening right here and right now. By the time it gets to the valuation, though, because these are done on a 2-year cycle, you don't necessarily see that impact in the MMO until the next valuation. But again, there's a lot that's going on in the valuation. This valuation, as I said before, also assumes that $36.6 million is in there. So, again, I apologize for the long-winded answer over there. I'm not looking at the Facebook Live. Did that answer the question, or did I get a follow-up question from that as we were going through this?
No follow-up from that from the live, but I do want to probably muddy the waters a little more. As you're speaking to the recalc from the 1 year to the 3-year average, I think there's still a question of, is overtime in the calculation? And
yes.
So there's that part, and thank you for answering that. So overtime, even with the 2017 labor contract negotiations, overtime is still a part of.
Well, so let me say it sort of differently here. In terms of, so when in 2017, for those who were hired after essentially 2017. Overtime is not part of that calculation. Right. It is for anyone who was hired, who was employed as a police officer as of, I think it was February, sometimes in February of 2017. So those individuals who were already here, yes, that overtime continues to stay in their pension calculation. There wasn't a question of whether or not overtime should or should not have been. The question there was whether the final average salary should have been calculated over the last 12 months versus the last 3 years. But for new hires, for new police officers, that's not part of their pension contribution. And also for those individuals, they're not, they don't receive retiree health care as well.
Right. And that's just sticking to the overtime piece. I think speaking to the recalcs and what we're currently working on, maybe muddying the waters for what the original question was. And then to what you just said about the immediate impact to anyone's current pension that's being recalculated, there's an immediate cash flow impact for the plan. But for something like the overtime being adjusted in the 2017 labor contract negotiations, it's not an immediate impact. It's 20 years until that new hire retires, and then you start to see some relief in the benefit calc there. So just getting back to the core question about, is overtime included? Anyone after 2017, it is not, but it will be quite some time before the city sees the relief for that. Actuarial, I guess, There is some relief in there as new hires are brought on, and they're brought on. The actuary is using a lower benefit level to calculate what the city needs to set aside. So there is some relief there, but it still would take some time for that to work through the MMO. And the majority of the workforce at this point is still probably pre-2017. So we're not seeing the relief just yet from that. So hopefully that there answered the question. And then one other piece about the plan being renegotiated, the benefit itself, I wouldn't see that as being renegotiated. It's the labor contract, and once we're committed to it in the labor contract, it sets a stage there. But I think we've addressed the open questions there, so ready to move on.
Sure. Yeah, and one final point I'll make on this, because maybe some folks are wondering about this. The majority of these liabilities that we see here on slide 8 in the police plan are from people who have already retired, or people who are here under the old benefit structure. And so the issue, if someone's asking the question, well, look, didn't you fix it in 2017? Aren't we sort of done here? The answer is really no, because most of the liability we see in this plan, and really in most of these plans, is already for those who have already retired. And it's also true for retiree healthcare. So just changing it for new hires or changing it going forward, that doesn't fix the problem, unfortunately. And in terms of what we were trying to figure out, so this is another question that folks have been asking, and we've been asking ourselves as well, is we're trying to figure out, okay, well, how much money needs to go into these pension plans, right? We keep talking about them being underfunded, to get a sense of like, okay, how much do we need to put into these plans in order for us to get an MMO contribution payment that's one, like, sort of, real, right? It's not based on receivables, but also something that's affordable for the city. Right? Because if we put money in, I said, even if we put the 36.6 million in, we still have an MMO of $12.5 million, which we've just seen from the previous slide, is going to be really hard to pay unless we find cuts someplace else. And cutting $2 million is not an easy thing to do. So what we've done is we've engaged an independent actuary to help us with some of these questions. And one of the things we asked them to do was to calculate how much the city needs to put into the pension plans in order for it to have really an affordable annual pension payment. And the way that the MMO works is that the better the plan is funded. So the more money is in the plan, the lower the annual pension payment is. And that should be kind of obvious, right? So the more you put in the plan, if it's, then the lower the MMO is. Part of the reason why the MMO is as high as it is right now is because is that it's not as well funded as it needs to be. And so when our actuary did this calculations, that what they found was, and this would be as of January 1st of 2022, for the city to fully fund its pension plans and to consequently have an affordable pension payment, it would need to add about $128 million to its pension funds. And that's the money that we think would need to go in there in order for us to have, to fully fund the pension plans and consequently to have an affordable pension payment. And what that would do is, the benefit of doing that would be you'd put the money in there, right? And that would lower the MMO contribution, and that would free up dollars that are going to the MMO to go to other vital operations for the city, whether that's salaries, whether that's additional personnel, whether that's capital needs, a variety of other things that the city desperately needs. But that number right there, the $128 million number, is really kind of where we're starting and really looking at for the amount of money that needs to go in there. And obviously, we said we couldn't get $36.6 million in operating. I mean, this $128 million is essentially double what the city's general fund budget is for 2022. And so the question for us is, how do we get that kind of money into the pension plans? And again, our options here are very limited. There's no reasonable way that the city is going to be financially viable without reducing these pension and retiree healthcare costs and depositing a significant amount of money into the underfunded pension plans. We're not going to be able to be financially viable without doing both of those things. And the only way for us to do this, to be able to put in an amount of money that we need to have an affordable pension payment, is monetization of an asset. And the only asset we really have here that could bring in those kind of dollars would be the Chester Water Authority. And again, as everybody knows, and this will probably gin up some of the comments that we didn't get this week, that remains in litigation. The ability for the city to be able to repossess the water system, to monetize it, that remains in litigation. The city won at the Commonwealth Court level, and those of you who have been paying attention know that. We had that in previous MFRAC presentations. But subsequent to that, the Pennsylvania Supreme Court has agreed to hear the case. And they can affirm the Commonwealth Court's decision, they can reverse it, they can modify it. But the fact of the matter is, we don't expect a decision on that case to occur until sometime next year. The briefs or the legal documents for the Chester Water Authority, they're due to the Supreme Court. So the Chester Water Authority's briefs are due on May 23rd. And then the responses from the city are due 30 days after. And it's likely that there's going to be oral arguments sometime in the fall. But we're not going to get an answer to this threshold question, this very, very basic question, until probably sometime next year. And again, the court's going to do what the court's going to do. But that's what our attorneys are telling us is probably most likely. And again, this puts us in a position where we're where we can't rely on this. There's uncertainty here as to whether or not the city can actually monetize this asset, and that again puts a lot of risk in the situation that we're in right now, especially in light of, again, the amount of money that we need to put into the pension plans, so they're affordable, and also so that we can continue to provide vital and necessary services. So again, at the next MFRAC presentation, I don't want to leave everyone here on a complete downer, but we'll provide the possible solutions. Today is really kind of going back and looking at the city's situation, looking at kind of the key indicators. And obviously there's other financial issues that are going on with the city that are important, that will have an impact overall. But these are the key critical ones. This is a threshold matter. If we have to address, unless we address these issues, everything else is not really going to matter. We have to address these top level issues. And again, we don't have a lot of options in terms of realistic options in terms of being able to do that. And we want to be honest with the committee, and we want to be honest with the community about the situation that the city finds itself in. And again, we're working hard to come up with several options or several plans forward, and we'll be talking about those on May 24th. So with that, that's the presentation I have for the committee. I'm happy to answer any questions that either committee members have or that may have come in as I was talking.
Thank you, Mr. Kapoor. I'll open it up to the full committee. Any questions of the information that was just shared here today?
I don't have any questions. Just want to say a good presentation, VJ. Of course, like we know here, you accurately and thoroughly provided the detail of the financial position of the city of Chester and its obligations to the very severe and underfunded pension that we have here in the city of Chester. I know the city, along with the receiver team, is continuing to work in partnership and collaboration to, of course, try to cut back on some of the expenditures that we have across all areas of the city of Chester. But we know that this one is very alarming, and we might have to do something or look at other areas that are most certainly more severe to decrease the amount of outstanding liabilities that we have on the pension. So I know there's one thing, of course, the monetization I think the mayor and council. It does not necessarily mean a sale at all. We just need to come to have additional conversations about how we monetize and get funds to reduce and or fund the pension fully for the city of Chester. So But thank you for the information, VJ. And I hope that it was well received by the public.
Thank you, sir.
BJ, if I could add, particularly from the chair that I'm in, this scenario is not uncommon among our third-class cities across the Commonwealth. We know that. But for receivership and the lens that we're looking at the city of Chester through, I guess, we are really seeing how bad this situation can be and is on the taxpayers across, again, in our municipalities. I really look forward to the solutions. Obviously, if there's something that we can mirror throughout the state for some of our other struggling third-class cities, we'll definitely take that. But I think this is a maybe extreme, but we still see the same set of parameters and then constraints around the state. I mean, cities just can't go in the back room and make money to cover these expenses. And there are key operational things we're mandated to provide in terms of services. So how it's balanced is anyone's guess, but thank you for the clarity and really the laser focus on the situation here in Chester.
Sure. And Director Bracy, and I completely agree with you in terms of what we see in other cities. And I know you work with a lot of them, and I've done the same. The one difference in terms of the severity in Chester's situation, I think, is as you pointed out, is this issue of the receivables, right? It's there's many places that are not 100% funded, right? I think the majority of pensions across Pennsylvania, whether you're a AAA rated or otherwise, very few of them are 100% funded. What makes this situation, I think, different here in Chester versus a lot of other places is that you have such a large receivable amount here that is assumed to have already been in the plan, but isn't. That's what makes Chester's situation, at least in my experience, as you said, more severe than you see in other third-class cities. But you're right. I mean, this is
Right.
pension issues are issues that we're seeing faced across the Commonwealth.
Thank you to the committee and to Mr. Kapoor for today's presentation. I too am looking forward to the 24th. Just before closing, one final public comment to share or open question for the committee, Mr. Kapoor. Why is no one pursuing Delcora? The city has options there if they are acquired by Aqua.
So to answer the question, we are.
Short and sweet. I'll keep my mouth shut and just say for legal reasons, we'll keep it short and sweet that way. But I did want to acknowledge that. Are there any other comments from the committee before we close?
I just want to second what everyone else has said already. Just thanks for the very comprehensive, detailed presentation. And I too look forward to, or am interested in hearing the next presentation on the 24th. Thank you.
Well, won't belabor this point any longer. Thank you for gathering here today. This meeting is adjourned.
Thank you all.